U.S. nat gas futures experienced a minor surge on Monday, rebounding from an initial decline, influenced by mild weather conditions and neutral weekend developments. Preliminary data showed that gas production in September decreased to 102.2 billion cubic feet per day, hitting a three-month low last Friday. Meteorologists forecast that weather will remain relatively normal until around September 23, but from September 24 to 30, it is expected to become warmer than usual. Cooler seasonal weather has led to reduced air conditioning usage and a drop in short-term gas consumption. Consequently, gas demand for the upcoming week is expected to decline. In contrast, gas flows to U.S. LNG export facilities have been on the rise, with LNG feed gas hitting a near two-week high on Friday, driven by increased flows to the Freeport plant. Meanwhile, the Cove Point LNG export plant in Maryland is scheduled for planned maintenance from September 21 to 29. Gas rig count, an early indicator of future output, rose 9 to 121 in the week to September 15, its highest since mid-August. Despite lower prices for gas, production was on track to rise from a record 98.1 billion cubic feet per day in 2022 to 102.7 in 2023 and 104.9 in 2024, according to the EIA. That is due mostly to increased interest in oil drilling in shale basins that also produce lots of associated gas, like the Permian in West Texas and eastern New Mexico. While current temperate conditions are tempering prices, lingering strikes in Australia have yet to make a tangible impact. The Wheatstone LNG facility in Australia, owned by Chevron, is back at full production following a strike-induced reduction. Both the Wheatstone and nearby Gorgon facilities contribute to over 5% of the global LNG supply. Despite the recent fault, production rates maintained around 80% of the usual output, with no disruptions to the scheduled deliveries. Yet, labor disputes continue, and further mediation sessions between Chevron and unions are anticipated. In the near term, the sentiment in the natural gas market leans slightly toward bearishness. The primary factor expected to shape the market's direction is the cooler weather forecasts. While ongoing talks regarding production and labor disputes at major LNG facilities in Australia may have minimal impact unless they escalate into prolonged disruptions, market participants will be vigilantly monitoring any abrupt shifts in demand, supply, or geopolitical circumstances that could potentially sway the market. In case natural gas settles back below the $2.63 level, it will head towards the support at $2.55. A sustained move over the $2.70 level will indicate the short-term buying pressure is getting stronger, with a retest of $2.80 as the next likely target. Thank you for watching. Please don't forget to hit the like button if you enjoyed the video. See you in the next one.